This podcast is brought to you by Consolidation Coach, the leading M&A consulting firm in the collision repair industry.
Hey there, it's Jason Stahl with yet another episode of Consolidation Nation, sponsored by Consolidation Coach. And as usual, we have on Laura Gay, who is the President, CEO, Big Kahuna, Head Honcho, Big Cheese of Consolidation Coach. Welcome, Laura.
Thank you, Jason. It is awesome to be here once again with you today.
Thanks for being on. And this is episode 10. This is kind of a milestone.
It is a milestone. It is absolutely crazy how this podcast has gotten to 10 episodes already. And it's amazing how I'm getting feedback from people binge watching the episode and having such amazing takeaways. It's been so helpful to so many. So it's been awesome. Thank you so much.
Binge watching. We thought that term was only for Netflix, you know? I mean, my goodness, here we are binge watching at Babcock's Media. This is wonderful. So we're going to talk about business valuation today. And, you know, I think some shops, they might get an offer from a consolidator and think that's what their shop's worth automatically. You know, they just kind of trust that process. But I want you to explain, I want you to kick things off for us to talk about business valuation and what it is and what makes a business valuable.
What makes a business valuable is honestly what another third party is going to pay for the business. And ultimately, how you figure that out is the keys to the kingdom. A lot of people, when they think about their business and, determine how they're going to figure out what that value is, usually they go one of two ways. They either say, hey, I'm going to go to my accountant, my CPA, and have him prepare a business valuation, because that's just kind of the general thing people in their mind think. Or they get a knock on their door from a consolidator or multiple consolidators, and they, start entertaining that and get offers. And that's usually the two ways that people, start to go down that road or that journey, if you will. I think it's important, before you get to that point, that you take some time, take some steps back, and really take a moment and think about your business. You get one chance in life to sell it. You can't make any mistakes. And most importantly, you don't want to leave any money on the table. And most people, when they sell independently by themselves or without a business valuation that is what I'll call proper, and is taking into consideration the market of consolidation, specifically in your region and attributes related to your shop, leave tons and tons and tons and tons of money on the table. Our business valuation is quite different than what you would get from a CPA, and definitely different than the offers that you're just going to get out the gate from a consolidator. So I think it's important to understand, when an accountant does a valuation, what that typically looks like. An accountant is doing a valuation from generally accepted accounting principles, also known as GAAP methods. And ultimately what that looks like is they're taking your profit and loss that is on your actual bottom line, net profits on your profit and loss statement, sometimes over a 2, 3, 4, 5-year period. And then they are, making adjustments to that number based on a variable of different things, where they talk about figuring out your adjusted EBITDA, which is a fancy acronym, if you will, for what your shop really makes after the dust settles. Well, a lot of times accountants don't do a very thorough job on this, because there's a lot of things that accountants don't really realize that the seller runs through the shop that won't exist post-sale. They don't really understand the consolidator and what their model is going to look like. And consequently, when they're doing the value, they don't really get a proper adjusted EBITDA. And then additionally, their method for determining what their EBITDA multiplier is going to be, and what that means is what that net number is, that adjusted EBITDA has to have a multiple applied to it. And that multiple in the body shop space is anywhere from, 2 or 3 to, I've seen all the way up to 10 or 12. And a lot of times when they are in that 10 or 12 mark, it's because the shop is not super profitable, and the shop or the buyer is simply just trying to support the value, if you will, or make it where they can get the deal across the table, if that makes sense. So that's one model that happens with accountants. The other thing that happens with accountants is many independent shop owners' profitability is very poor, whether it's a one shop, two shop, three shop. I've seen many shops that are busting their ass. They're doing $8, $9, $10 million a year, multiple locations or more, and their profitability is just not. It doesn't exist, even with adjustments for personal expenses or other expenses they run through the business that won't exist later in time. So then you've got to really balance this valuation and look at, what is the market going to demand for this shop? And the market demand is based on so many different things. And I think it's important to take a minute and dive into that as well.
So Laura, you earlier mentioned leaving money on the table, and obviously no one wants to do that, but you have personal experience with that. A decade ago, you sold your shops and you feel like you left money on the table. So talk to me about how you feel that experience benefited you and got you to where you are today with Consolidation Coach, the leading consulting firm in the country, consulting body shops on selling. Tell me how that's helped you.
When I sold my stores, I was 42 years old. I was not in a place mentally to sell. Really what happened was consolidation. Our market was the first market that consolidators decided that, hey, we're going to enter. My stores were in the Washington, D.C. metro area. And when that happened, we started having consolidators knocking on our door. And my mindset is like, this is not ever going to work. I had a really good friend of mine that was working for one of the consolidators that had sold, approached me and say, Laura, this is probably something you really should entertain. So I entertained it. I got an offer or offers. And then I said, you know what? I need to take some steps back, learn as much as I can about auto body consolidation, understand how these values are determined to make sure that if I am going to do this, that I don't leave any money on the table. It took 6 months. I got certified in mergers and acquisitions during that time period, learned as much as I could possibly learn about it at that time, and went to the table, negotiated significantly more than those offers that I had originally received, ultimately ended up selling the stores. But during the process, there was some, for lack of better words, nuances that were within the contract where I made some major mistakes and quite honestly cost me about $1 million. It is so easy to make mistakes, and not just on the business value, but just through all of the nuances. And there's just so many places for money to be left on the table. So consequently, what happened was I was helping, when I post sale, I had a lot of friends in the industry. Just because I've been so well connected. I've been in the industry now 34 years. Yes, I'm telling on myself. And they just started calling me and saying, hey, Laura, what's this? What's that? And then it just, dawned on me, hey, I need to create a business that helps these independent shop owners that are just like me. There was no shame in my game. I'd be in the detail area washing cars on a Friday. If bumpers needed to be scuffed on a Thursday, I'd be out in the shop, scuffing bumpers. I mean, that wasn't my ideal scenario, but if it needed to happen, I would get in the mix and make it happen. And I think that what happens is when you are thinking of selling your shop, it's easy for an offer to get thrown in front of you. You're having a bad day. You say, gosh, what I could do with that, and really not look at it objectively. And I think it's important, if you think you're going to sell, you're at burnout, you're like, I'll just take anything. That's just not a good place to be. And you have to take some steps back, understand the whole process, understand the value, what drives the value, and the seasonality of value, because the value right now in today's market versus a year ago versus what I think 2026 is going to look like is 3 different animals. And they vary so much that you have to really talk to somebody other than a CPA who's just busy focusing on tax returns and not really in the mix of knowing what the markets are doing and and that's another big thing, the buyers. What buyers are in your market? Who's, somebody might be in your market and they're looking for a highly certified shop, Mercedes-Benz, BMW, Audi, Rivian, that type of thing. And your shop might not be ICAR Gold and may not have any certifications. Well, that buyer is not going to be interested in you. You know what I mean? And consequently, then that's something where, if that's the only buyer in your market, then offers aren't going to be that great. And vice versa, if that same buyer is in your market and that's who you are, that's when, the for lack of better words, the iron strikes. And that's when, I guess, timing is what it's all about. Selling your shop isn't always on your time. Case in point, me, I was 42 years old when I sold. Insane. You know what I mean? And I'm very grateful. I'm a firm believer God gives you what you need when you need it always. And it has definitely been the best decision that I've ever made in life, was selling then. I love the life I live now. I travel a lot. I love helping shop owners not make any mistakes or leave money on the table.
That's great. And so, Laura, let's talk about, bullet point for me, what makes a shop valuable, the attributes. Is it certifications? Is it DRPs? Is it square footage? Talk to me specifically, bullet point for me, those attributes.
Again, it comes down to market and who wants what, who's in your market buying, what buyer is there, ultimately drives all of these things. But the things that ultimately, for lack of better words, just keep stacking up to increase value ultimately overall, is it starts out with, is the shop, 10 to 15,000 square foot minimum. The bigger the population, the bigger the shop needs to be minimally. Does the shop have, $2-3 million in sales? That's kind of becoming the new standard, if you will. Is there a minimum population of like 30,000 people? The consolidators used to look at stuff that had 10,000 square foot. Well, now 10,000 people. Now it's 30,000 people, in a market, and that's pretty much their minimum. And the reason why is they've learned, just like we've learned with running businesses and life, they've learned that those markets are super challenging to conduct business because, if they lose an employee, it's really hard for them to replace the employee because there's only so big of a pool. ICAR Gold is big. OE certifications. And, again, that serves a whole gamut as well. You can be from, the, we'll call it the certifications that, you can buy and have inspections that you have the equipment stuff. And then you have the certifications that you have to earn, like BMW, Mercedes, Rivian, and stuff like that. That is a huge swing between that. Being DRP centric is a huge thing. Typically non-DRP shops are definitely more profitable. DRP shops are typically higher volume and again, there's a gamut on this, but a consolidator specifically wants a DRP centric shop because ultimately that's the model they're going to follow. And consequently, when you are a non-DRP shop, and it's not a deal killer, but a lot of times what happens is your employees are programmed that, hey, we drink Diet Coke here. That's what we drink. Don't come in here and try to give us water because we're not drinking water, and that honestly is a big part of it as well, because the consolidators, they know if they buy a shop that is non-DRP, they know that they're going to lose people. And that's a huge part of the acquisition, is the people, the culture, and what you have built. And they want to keep and embrace all that. I think that's the high level, stuff. There's a ton of other attributes after that, but I think it's fair to touch on equipment. A lot of people in their mind, shop owners, when they're selling, they're like, well, I've got this, which is all great and important. But I hate to say this, that is like so low on the totem pole of what brings value to your shop. It's ridiculous. And it shouldn't be that way, but ultimately that's truly what it is. But I think that's in a nutshell, what drives value, specifically as far as attributes. But the other things that drive value that's unrelated to those attributes is, like I said, the population in a market, and mostly how many buyers are in the market, what buyers are there, and how that conversely relates to you as a actual seller, if that makes any sense.
Yeah. So you go to your CPA and, they're just going to base it on the numbers. So it's not, your valuation isn't exactly accurate. There's more there. You get an offer from a consolidator. It could be a low ball. When they go to you, when they go to Consolidation Coach for a business valuation, what does that include and what's your fee?
So in our valuation process, what you should walk away is a crystal clear mental painting of what your life could look like post sale, from what the sale price of the shop is going to be, all of the nuts and bolts, if you will, of that sale and how that's going to affect you. Understand the taxes and ultimately what the net amount is you're going to get for your shop. Understand the real estate and what that looks like. And that's a whole nother, play, which we can talk about in a moment. But the real estate and understand what that's going to look like, whether, you're renting back the property or you're selling it post sale, and ultimately how that's going to affect your landscape post sale. And then lastly, and most importantly, the taxes help you understand that whole model, because the taxes are not done like what we traditionally think of. Okay, I'm going to have to pay 40% on this transaction. They're done through what's called an allocation process. And allocations, simply put, are basically, there can be 3 to 5 buckets but for simplicity today, let's just say there's 3 buckets in front of us. That money that you get, let's just say it's $3 million, has to be divvied up into these 3 different buckets. And for just discussion today, let's just say they're assets, your non-disclosure, and your goodwill. Well, each one of those buckets are taxed at a different rate. So what's favorable for the consolidator, which bucket is favorable for the consolidator, is not favorable for you, and vice versa. So just like we have to negotiate the sale price and all the nuts and bolts related to the actual sale of the business, whatever happens with the real estate and everything related to that, how much cash you're getting up front, is there an earnout? Because that's a big part of a lot of deals that we're seeing in today's market, and understanding that. And, are you actually going to, the earnout, is it attainable? Is it something that you're actually going to see? But that's a huge part of it, is the tax piece, because, if let's just say that, most of the money or the lion's share goes in the one that's favorable for the consolidator, that's going to cost you a ton of money in taxes that can be negotiated and be very favorable for you if you understand it and if you handle things appropriately in the right timing.
Yeah, and let's talk about that real estate piece, because I know you've, in your articles on bodyshopbusiness.com, talked about mailbox money. It seems like today, most of these acquisitions, it's a no-brainer for the shop, to the original owner, to retain the property and lease it back to the buyer, and then they get mailbox money, right? But talk to me about that aspect, that dynamic.
Yeah, absolutely. So when you sell your shop, it's 2 separate transactions. There's the sale of the business, and then there's the real estate and whatever happens with that. So with the real estate, assuming that you own it, you have an opportunity to either, keep the property and lease it to your purchaser, which is, in our opinion, the very best exit for you, because of having that mailbox money. Most of the time, most shop owners make more money on their rental income than they do in their shop. So it's a total no-brainer. Additionally, they're building family wealth. They've got a piece of wealth that can't be spent, for lack of better words, unless it's sold, that you can pass down to generations, and will continue to, for lack of better words, print money for you and your family for generations to come. So in our mind, that's, we're all about building family wealth. That's the very best route, in our opinion, in most cases. Then you have, the option to, get that lease in place and then sell the real estate post sale. That's probably the second choice. And the reason why is, and I'll give you an example. 10 years ago, when I sold my stores, my property was on my big store was worth $1.8 million. Post sale, maybe 30, 60 days, 90 days after the sale, I started getting offers for the building from these real estate investment trusts and brokers and different things that were, trying to get me to sell the property, because that property then becomes from a owner occupant to now it is an investment property. It's for lack of better words, it's moved from here to here, and now it's hot. Everybody wants it because God's not making any more industrial property. And, it's a very hot commodity, our types of properties that body shops can, conduct business on. Additionally, they like it because all of these consolidators, like Caliber and Gerber, they are solid credit tenants. Most of the leases are corporately backed. They know that they're going to get their money every month. They're not going to have to worry that a month is going to get skipped. So these investors really, really like them. And again, I started to say my property was worth, I think I'm going from memory, 1.8 or 1.7 million, right in that range. We had just gotten a property valuation done because we had just refinanced it when we sold, and we're getting offers for $5.5 million for this property. So that's a huge, amount of money that if I sold the property directly to the consolidator, just thinking, look, I just want to be done. I'm just selling the whole kit and caboodle. You're leaving money on the table. So it's so many places, literally, that customers leave money on the table. And lastly, your option is to sell it directly to a consolidator, which is the absolute worst decision that you can make. Again, I am here to help people not make mistakes, educate them, make sure that they're not leaving any money on the table. And as far as our fee for the valuation, it's very thorough. We have a CPA that works for us. He does all the analysts work for us, and he does basically a pre-game of looking at your financials to make sure that when you get your offer and your letter of intent is signed, the next phase of selling is through due diligence process. And one of the huge parts of due diligence is the financial due diligence, or what they call a quality of earnings. That is what blows up deals 80% of the time. So if you don't have your financials in order, you don't have your house in order, and you can't get through financial due diligence, there's no point in going to market and getting an offer. It's a waste of time. So a lot of times through the valuation process, we learn that the financials are not strong enough, or they're not going to get them through the financial due diligence process, because we're basically pre-gaming that, because we know what the consolidators are going to look for. So that's a huge part of the valuation process internally. But externally, what the customer gets is, like I said, a crystal clear understanding of the value of their business, from the business to the real estate, the taxes, and ultimately a net picture for just $3,850, like pennies. That is our cost. It's very thorough. We have at least 20 to 25 hours in these business valuations before we even deliver it to the customer. And then we spend anywhere from, an hour and a half to 5 hours with our customers delivering it and making sure they understand all the facets so that they can make a good decision. And it's so easy to get caught up in the pomp and circumstance of, oh my gosh, I just got an offer for $5 million. Like, it totally changes my life. Well, you know what? What if you got 7 million? And the other thing you have to look at is the whole enterprise value, the sale price and all of the nuts and bolts, and the lease and all the nuts and bolts, or the sale of the property, or whatever that looks like. And ultimately take that and then come down here to the bottom corner. And what does that number look like? The enterprise value is so important, either over a 10-year time or 20-year time, or whatever leases that you have. It's important to look at that enterprise number, encompassing. And that's where we try to help people not make mistakes and not leave money on the table.
Wow. Laura, I think we've covered a lot of information here, and I think we have a clear understanding of what valuation is and the pitfalls of relying on a valuation of your business from unreliable sources versus a reliable source like Consolidation Coach. So I really appreciate your time today. Thank you so much.
Yeah, Jason, thank you so much. I think it's an important topic that a lot of people just don't understand. A lot of times when I talk to people, about a business valuation, a lot of people get hung up in the thought of, oh, I have to spend $3,850. That $3,850 will pay you back dividends, whether you use me or you use somebody else, or you do it on your own. Like, you will walk away with a college level education on selling your business, and only specifically tailored to you. And I think that's where people get lost, for lack of better words, in the sauce, and get lost in the translation, if you will.
Yeah, what college costs today, that's a bargain, it sounds like.
It is. It truly is. And like I said, it's our dead cost. It's what it costs us just to manufacture this report and this, package, if you will.
Yeah. Thanks again, Laura.
Thank you, Jason. I appreciate you having me today.
I'm Jason Stahl. Thanks for watching.